Hey, everybody. Welcome to week 187. Hey, guess what? It's going to be the last one of 2023. Just saying, we're going to take off for Christmas. And since Christmas is coming a week from Monday, and a lot of people are taking off trying to get vacations out, we're going to just like celebrate and give you guys 2 weeks off too. So, anyway, so we are going to go in. Yes, we were talked about as being Santa's helpers and trying to deal with, hey, these are the things that your CPA should be talking to you and not keeping secrets. These are not to be Christmas secrets. So I got to do a quick shout out though, because the Jingle Bell Run was this last weekend. And our very own Zach Krasinski won the whole stinking match. And nobody was between him ever and the Pace motorcycle. So he blazed it through at 18:53. And here's the thing. This is the best part of this story. He won by about a minute and a half. That was the closest competitor. But we didn't realize that when we bought the bibs for everybody, because we had 18 of us from BGW that did it, we didn't get the chipped ones. So they didn't acknowledge his first place finish. And the guy that won the medal had it. And he's like, and he knew Zach. And he was kind of like, yeah, like you like kicked my butt. And he didn't give him the medal, which is like, who wants the medal that he didn't even win? But nonetheless, here was the best part. Zach just was still grinning ear to ear because he got the time that he wanted. And I just thought, man, that is the best. That says a lot about somebody, like he's just a great kid, and kid compared to me. But I love that team that we've got, and it was so much fun. Jingle Bell Run. I think I'll have to do it again next year, but hopefully I won't be 4 weeks without working out because of an eye surgery. So anyway, so Merry Christmas to everybody. A little bit early. We're going to talk about the stuff that you should be talking to your CPA, or they should be talking to you about it. And if we're your CPA and we haven't been talking about it, then box us upside the head, because we need to be. And typically we're trying to talk about this kind of stuff throughout the year, so it's not just a last minute cram. So speaking of cram, I'm going to kick this over to Jack Santinello, because he was talking about he may have to cram because he may have to do an all-nighter to get stuff off his plate before Christmas. So Jack, you could confess if you want to. You don't have to. I've already outed you. But you could talk about other stuff that's really pressing.
Yeah, well, okay. So yeah, it's procrastination. Well, Adam shared a quote with what procrastination really is. And so yes, I will be I promised myself I would not leave. I will be going uptown to my office and will not leave tonight until there are two piles of things on a table that I have in my office, one for two different paralegals, and they have been harassing me for those, but I will get those to them before they go on vacation and stuff. But I, just in case this was going to be our last one, which I wasn't sure until you said that, I came prepared.
Oh, is
This
it
is
Duke and oh no, it's not.
Oh,
It's
heck
UNC.
no. This is the topper for the Tar Heel tree. This is what happens when you graduate from Carolina and then a few decades go by, and then you have an actual tree that's dedicated to the ornaments that your parents get you on an annual basis that they subscribe to, and they're really cute ones with like Santa and Ramses and things like that. So maybe
And
after,
Ramses.
yeah, and I'll take a picture and share it next time. But um what I wanted to talk about, and I'd mentioned this before, the Corporate Transparency Act, and it impacts all of us, and for two reasons. One is that for any businesses that were in existence prior to January 1 of 2024, then you have until 2025 to report essentially who are the underlying owners of that entity. And it's pretty intrusive, I think, beyond what is currently required to be reported. If you form an entity starting next year, as of January 1st of 2024, you have 90 days to report this information. And then if you form it in 2025, you have 30 days to report this information.
Wow.
What that means is, and we had a long discussion in my corporate group monthly lunch yesterday about this, and we have our IP and our commercial real estate and other people, litigators, come in because it's a good way of disseminating information. What it means is that when we form an entity, when you form an entity, you have to provide for, if you're forming it on behalf of someone else, then you have to get certain information that needs to be reported. And so it's going to be a surprise for people. It's going to be, wait a minute, you need my driver's license number, passport number. I mean, you know, so all these things, people who like to be in obscurity and not let people know that they own certain things, and you know, that anonymity cloak is no longer there. Now, what is not going to happen, this is not public information. This is going into a specific federal criminal database, essentially, that would be accessed by law enforcement around the world. And the purpose of it, and I'm going to pull up and give you a little more information than I did last time, because I think last time I kind of scared everybody into like, oh crap, here's what's coming. But so here's the lead in. In 2021, Congress passed this Corporate Transparency Act, so the CTA. It creates a new beneficial ownership information reporting requirement as part of the U.S. government's effort to make it harder for, and this is the purpose, the true purpose, but we all get swept up into this, which is make it harder for bad actors to hide or benefit from their ill-gotten gains through shell companies or other opaque ownership structures. And then, you know, I talked about what all that means as far as the timing goes. We will be publishing the abbreviated version of all of this in a client alert about the Corporate Transparency Act. But I'll give you kind of the snippets of it, and then, you know, if you reach out to me, I'll put you on the distribution list for all of our what we send out, but specifically for this because it's really important. Both domestic companies and foreign companies registered to do business in the U.S. or any of its states or territories are categorized as reporting companies and must comply. Now, there are exceptions, but most of us are not going to apply, or those exceptions will not be applicable to us because we're not nonprofits, we're not governmental entities, et cetera. Information that's required is the name of the company, trade name, DBA, address, IRS tax ID number, EIN or tax ID, information on certain major owners or members of management, which are considered beneficial owners. So get used to hearing that term because that is important. So it includes full legal name, date of birth, current address, U.S. passport information, driver's license, image of the document chosen with identifying number shown. So now you have to scan your driver's license, passport, et cetera, if you are a beneficial owner in one of these companies. And then it goes into who are beneficial owners. So it's typically controls at least 25% of the ownership interest in the reporting company. It goes into what the definition of control is. And then there is, and actually it isn't on, oh yeah, it is. Let's say, what are the penalties? $500 a day with a maximum penalty of $10,000. Now that gives it some teeth, but here's where the real teeth comes in, which is possible imprisonment for up to 2 years. A couple of Jack thoughts on that, which is interesting that they made the new entity reporting requirement. Yeah, well, they grandfathered in current entities and entities that are formed before December 31st that you don't have to report until January 2025, which happens to be after the next election. Recall, this is federal government, it's regulatory, and so who controls that? Essentially, you know, the executive branch through the judicial branch coordination of that. Secondly, that it is, how are they going to, again, with the PPP payments, with enforcement, with fraud and everything else, you have to have an infrastructure to enforce things. So Jack theory is that, there's going to be mess ups. People are not going to do what they're supposed to do inadvertently. Some people will do it purposefully. But, are you going to have U.S. Treasury, IRS agents, and others, the Department of Justice, barreling down your door because you did not report beneficial ownership of one of your 25% owners? And the answer to that is just simply no. They're going to go after the people that are really the offenders. Now, again, as we talked about in previous years with PPP, when you create a database with automation and reporting, and now where we're at with AI, you can automate the, hey, by the way, we noticed that you formed this new entity. We were made aware that we matched up your tax return and it shows 4 owners. You didn't report them. So get it together and send us what you're supposed to send. And if you do it within the next 90 days, you won't get penalized. I mean, again, I'm making that up. So the reality is, I just want to temper. I mean, this is very important. It's very intrusive and it is required at this point. But I don't want to panic people and say, oh my gosh, I missed, it's 95 days in and I missed that. And then I think we also talked about the fact that many of the CPAs and investment advisors and brokers and everything else are looking, the buck stops with the lawyers. And so that's why we're making a very large effort to inform clients of what the process is, what we will and will not do. For example, if we're not going to go and clean up a cap table for you unless you pay us fees to do that. To do that because the client hasn't cleaned up their cap table for the past 2 years. And nor are we responsible for updating that. So a subtle point, but important point is change in ownership is also required to be reported. So you change a 25% or more owner in a very simple asset or simple stock purchase, or what is not clear, and I'm not sure about when you have a redemption. So you have an increase in ownership or change in ownership based upon absorption of those ownership interests. But more to come. And in fact, if you were to ask me, hey, that sounds interesting, can I see the form we're supposed to use? Can't give it to you because we haven't been provided it by the federal government. And apparently the database that you're supposed to report into is not functional yet. Kind of sounds like deja vu.
Woo.
Back to the PPP days, right? So that's the snippet on all of that mess.
Yeah, I got to tell you, the thing that I'm just racking my head about, Jack, and maybe you have maybe there actually is a thing that I'm just not thinking of, because clearly, I think this is the dumbest thing that's ever been done. Because for the following reason, the window of time between me reporting and filing a tax return with the same information, minus the driver's license and the passport, which they can get from the states, and actually they issued the freaking passport, is months. And like, I can't even, I'm sitting here as you're talking about this, racking my brain with what is this scenario where I'm going to report on a tax return ownership that's different from what it actually is. Because I have to report all those same ownership changes on a tax return. So it's like, what in the actual, and you can finish the sentence for me because I'm not going to swear today, Gary, at least not at this part of the presentation.
Good for you. Yes,
it's like, I don't get it. And I hope that somebody in Congress or somebody somewhere that actually has sort of like a little bit of a data background could say, hey, idiots, did we know that we actually already had all this crap anyway? Because like I had to apply for the EIN, that's with the IRS. I had to file a tax return. That's with the IRS. I had to get a passport. That's with the federal government. It's like I had to, my driver's license, guess what? For me to do my I verify fly thing, that's with the freaking federal government. It's like, Lord.
Yeah, absolutely. I mean, it's just, and I was actually, I have a draft of our questionnaire that we are going to be giving out to clients. I mean, it is, the days of, hey, can you form a single purpose entity for this transaction or do this and that, and then it rolls up into, structure like commercial real estate where you create an entity for each property, but it rolls up into a joint venture, which then rolls up into something else. It's just, it's going to be a
All done.
challenge. I mean, yeah, I mean,
Yeah.
there hopefully will be some efficiencies so that if you end up that, okay, the ownership does roll up into the same individuals, then there may hopefully are some efficiencies. But a lot of times joint ventures, it's okay, you have a core and then you have maybe someone in that geography that is an operating partner that has an ownership interest, which is a different person than somewhere else. And so, it's just, but you're right. I've wondered that too. It's like, okay, well, why are they not pulling information from tax returns? And someone said, well, tax returns only go so far as how deep into, and if you have it layered, LLC on top of LLC on top of LLC, you're not going to get to the end game, essentially, to the puppet masters of that
And
that corporate org chart.
I find that's a bunch of BS. With AI in about 3 hours, I guarantee somebody smart can figure out how to trace that all the way back. Because you start with like a Social Security has an EIN reported to it, and then you look at like that EIN's tax return because it has to disclose what EINs roll up into it. This is not. Again, I'm 1000% confident this could be figured out real quickly by writing a little data query and saying go, and I could have like a map of like every Social Security number and everything that they own all the way down constructively and what sits in them. Like, it's not rocket science because all this crap exists in tax returns. Anyway, tirade done.
Well, here's an interesting also just side note, which is there is a case that was filed in mid-November by the National Small Business Association and an individual suing Janet Yellen in her official capacity as Secretary of the United States, the Department of Treasury, and then the director of the Financial Crimes Enforcement Network, which is the regulatory agency that is doing this. So it will be interesting to see, because obviously they're challenging the validity of the ability to impose these rules and legitimacy of and on multiple grounds. I haven't read through the entire very long 40-page, 50-page complaint, but basically it would be along the lines of didn't have authority to do it in the first place, and then it's an invasion of privacy, and how are you going to make sure the information remains where it's supposed to remain and doesn't leak out, because there's so many hands that can access it now. If Interpol, all these law enforcement organizations. And so, it's, but the rebuttal to that is, well, if they are not doing anything illegal, then they have nothing to worry about, which is, the stupid argument that everybody puts out when it's like, well, if you're not doing anything bad, then why are you worried?
It's less that. It's more like, look, you're not, because you're going to say it's stupid. You're not going to charge what it really costs you to do it, but then the client isn't going to want to pay it anyways. It's like basically, I don't know if you guys have estimated it, but my best guess would be you just tacked on, $1,000 to $5,000 a year, to every small business in America. Just keep track of this crap.
Yep.
Yeah.
For no value that I can see. So again, this enough bitching. Start Congressman writing.
Yeah, right on.
So, in all
I just
seriousness,
think it's funny.
The AI CPA actually has a form letter for us to be sending into our congressional offices to say this is the biggest crock of hooly balooly. I mean, not the biggest. I'm sure there's been bigger, but this is quite large.
It's traditional bureaucratic professional politician rules for thee, not for me. And they usually make rules to keep people from doing what they're doing.
Yeah, that's right. Yeah, no, that's
I
right.
mean, look at all the stinking shell companies and people in high places. And
Yep.
I mean, it's just crazy. So 2 questions have come in. First of all, and I think you answered it earlier, but Derek says, hey, will this apply to nonprofits where there isn't an owner? I think that answer was no. Is that correct?
That's correct, but also understand that nonprofits are allowed to run for-profit businesses, and there's income reporting requirements in that. So just need to be aware that usually yes, but there are some exceptions.
Okay. Second question, I'm glad you're sharing the definition of beneficial ownership greater than 25%. In addition to myself as the founder and investors, will be offering equity to all of our employees, which sounds like ESOP, maybe not, but that did make me go, what about ESOPs? Which could be a bit of a nightmare to report this every month.
Yeah, and there's more to come. I mean, this is, I would not be surprised if someone says, well, first of all, that in this federal court in Alabama, I keep saying Illinois, but Alabama, that puts a stay on it and says, let's figure this out, and then it pushes it back. The problem is that until that happens and we're on the precipice of a 90-day clock starting to tick in a few weeks for entities that are formed, which is also why when we know in this moment, in the past few weeks, that a client wants to form an entity in the near future, we tell them, you go through all this with them, and we say, it's our strong recommendation you form the entity in 2023, and that gives you at least a longer leeway, runway to not have to do anything on beneficial ownership reporting, and hopefully it goes away. So, but we have to be prepared with the forms and everything else. And Adam, as you said, it's like, okay, we're not going to do it for free. Someone has to pay for it, and we're trying to do it in the most efficient way by appointing and having a process in each of our offices, by having at least 2 attorneys, 2 paralegals that know what to do. They have access, and they are now the funnel of any new formation of entities in our various jurisdictions.
So here's another question. You're a partnership, but you're going to change over to an S corp. Does that trigger? I mean, it's and it may be even, just a tax reporting change.
I'm not aware that is a reportable event by changing the tax structure. It more focuses on ownership. So if through that change, there might be a change in ownership. And what I don't know in this moment is, okay, let's say that through that you change the ownership percentages, but it's the same 4 or 5 people, but it's
Right.
not a new owner that's coming on board. I don't know that for sure. I've not dug that deep into this. We have a committee that is doing that, but those are all questions that are going to come up, and I'm going to have to know that answer very soon.
Yeah. Well, this is great insights and good updates. I think what we should do is just vote to put all the elected officials on the naughty list, and they should get lumps of coal. So that's just my opinion. Let's see. Also, less of a question, more of a comment. Banks already have to establish beneficial ownership already for any new accounts, loan or deposit, with the same 25% requirement. That's good information to know. Thank you, Derek. Appreciate that. All right. So, Adam, I'm going to tee you up. What are the secrets that CPAs should not be keeping from their clients unless they want to get put on Santa's naughty list?
Yeah, I think the reality is people are just like, I love our business. I'm sure it's the same thing in the legal world. Like, people just get, busy and lazy. So, not to be a jerk about that, but that's just the reality of what happens. So what I thought would be helpful would be to go through, like, what do you actually need to do before the end of the year versus what can you do after the fact, by just doing some homework. And some of this stuff is kind of, I'm not covering a lot of the basics, but because I mean, lot of our clients already know the basics from these webinars. But the first one we actually talked about last week, which is if you are a business owner of an S corporation and you are the only employee, you need to get your wage set for the year because you got probably one last payroll run to do. And to do that, you want to make sure that you maximize the qualified business income deduction, which is, based that part of the 2017 Tax Cuts and Jobs Act. You get to pay 80 cents on the dollar. There's like a magical formula for like, since you're the only employee, you are the wage deduction, to still get the benefit, but you still need to have some income to only pay 80 cents on the dollar for. So here's the magic formula. 2/7. So if I make $100 before the wage, 2/7 of it needs to be W-2. That should be your final W-2 number. That needs to obviously happen before the end of the year. That's item number one. Item number two is and also like if you're not maximizing, just to, if you need to raise your wages a little bit, you got a couple other people on the payroll, but you're making a killing, you just need to look at it to make sure that you're maximizing the qualified business income deduction. From the other perspective, you've got the scenario where, again, you're S corporation and you're killing it, Jerry, you're killing it. And part of killing it is that, hey, company's doing really well. You made, $2 million in taxable income, and you've been following, some sort of loose rule of thumb of what you should be paying yourself in a W-2 as a reasonable wage. So your W-2 is set at 500 grand. You're overpaying yourself. Like a lot of people are like, well, will that raise a red flag if I were to reduce my wage? The answer to that is never have that be a problem as long as you pay yourself the Social Security limit, which is about $160,000. So what's it costing you to do that? Well, in that particular scenario, you've got $340,000 of income being taxed at effectively 40% when it could be taxed at 28%. So that's, that's your offset. That's item number two to fix. Item number three to fix is that, and you can go back and amend payroll tax returns. What you want to do is you just want to make sure your year-end W-2 is right, versus having to amend W-2 after the fact. The next thing to focus on that's related to wages is if you're a C corporation. So it used to be in C corporations, oh my gosh, I've got double taxation, without representation. That was funny, Jack, right? Double taxation without representation.
Yeah.
Anyway,
Schoolhouse Rock.
What's that? Yeah, Schoolhouse Rock, baby. Yeah. Schoolhouse Rock. So what you would do in that scenario is, instead of having the C corporation pay taxes and then you have to pay taxes on the dividend when you take cash out, you just would bonus out all the money. Like you just, okay, well, cool. We'll put it all into our W-2s, and the taxable income of the C corporation, will be nothing. Well, the problem with that now is since they lowered the C corporation tax rates to 21%, and then the dividend tax rate stayed at 20% if you're in the highest income tax bracket, is that if you've got a scenario where you actually made a good bit of money, but you need to retain some of the cash in the company to invest and grow, or you made a good bit of money, but there is no cash to pay the dividend anyway, because you pay down some debt. That doesn't make sense anymore, because now if you were to take taxable C corporation income at 21%, then turn around and distribute the remaining cash at a profit or at the qualified dividend rate, the tax rate that you're paying on that is roughly equivalent to what you would have paid as a W-2, all else being equal. So it's same. But if you weren't going to distribute all the cash, it's actually lower to go C Corp tax dividend route because you're not distributing all the cash. You can control, like, if I made $1 million, C Corporation has to pay $210,000. But if I was only going to pay 100 grand in a dividend, that's another $120,000. So I've got, or another $20,000. So I've got, $210,000 plus $20,000. That's $230,000. Last time I checked the math, Gary, that's an effective 23% tax rate. Versus if I bonused out all that money, but like I wasn't going to be able to take it out, I was going to have to loan part of it back to the company or whatever. That's taxed at a 40% rate. So you're clearly better off going the dividend route. My only point in saying that is that's another one where if you've already made some payroll plans, you just want to revisit those, before the end of the year, just to make sure your final W-2 got right. Next thing, moving on, is I'm still dealing with wages right now, but, determining what you want to, like, you can't start a 401k plan right now. It's too late, but determining what you want to put in it, now would be the time to be performing those calculations. Again, so that your W-2 is right, so that, if you want to max out your deferral, and then if you're over, 50, do the catch-up payment. If your spouse works in the company or doesn't work, sorry, you aren't recording this, right, Jack? If your
The
spouse
recording's
is,
going.
if your spouse is air quote working in the company, but not actually working and participating in another qualified retirement plan, pay them too, defer all the money, into a retirement account. It's a way for, like, in the Gary Fry family, Gary can participate in the 401k plan, but so can Jennifer. So it's a way for Gary to double down on the retirement, relative to just Gary did it himself, which is always a great idea if you got the cash available. That needs to be done before the end of the year. If I'm actually sitting in someone else's office today, Laura Bossert, and a picture of two of her children behind me. I've seen them in here doing a lot of work. Thus, if I wanted to pay them, I would want to pay them before year end. And if you pay your kids below $13,850, it's free. So why not do that? That's 27 grand, right there. Next item on the list. If I was going to buy a bunch of stuff, meaning like, hey, I was going to buy it anyway. Like, Adam's never a fan of buying crap for the sake of buying crap. You should buy for tax deductions. You should buy something you're going to buy anyway. The bonus depreciation rules, this year is that if I spend $1, I can depreciate it right up front 80%. They go down to 60% next year. You still get the full depreciation. It's just slower next year. So, if you're going to do it anyway, you might as well do it in 2023. And you need to have taken delivery, of it, typically, for that deduction to stand. And then last but not least, before year end, any, kind of any charitable giving, like, hey, I heard a thing on the news the other day that talked about the Magnificent Seven, like Apple, Tesla, there's like 7 Fortune 100 stocks that have basically been the entirety of the bull run that we're experiencing right now based on their growth. So if you own those and thought, hey, I'd like to donate some of this money to charity, making your donation prior to the end of the year is important, meaning like if I've got appreciated property, I can make that, like, I can transfer that stock to my church, for example, and take the appreciated value of the stock, even if my cost base is low. But I got to do that before the end of the year as an item. Related to that, You go back to Magnificent Seven, as an example, um, it can't hold, so if you've got other problems in your portfolio, looking at doing some gain and loss harvesting, all that's got to be done, at the end of the year, which your investment advisor should be helping you with. But, it's just a question to ask, it's a question to ask yourself, and then lastly, again, related to stocks, is that, if I had kind of a crappy year relative to any prior year, like business had a loss or like, hey, income's way down this year, um, it's an opportunity to, like, let's say Gary's at, like, again, 10% tax bracket, it's been a crappy ass year, but he's also got a significant amount in a pre-tax 401k account, and he'd like to utilize everything up to the 20% tax bracket. So what he does is he converts some of his pre-tax money to post-tax money, just to utilize any tax bracket stuff that's available relative to what he thinks his tax rate is going to be when he retires, which will probably be higher, than 10%. So, kind of making use of your tax brackets now if you had a bad year, to harvest, just to convert anything over and just go ahead and get it taxed now while tax rates are low. Not a bad idea either if you can stomach paying the tax before you have before you actually get to put your hands on the cash.
So move it to a Roth IRA.
Jack was
Can
going
I
to ask. That's
Can I ask a
exactly right.
question?
Yep.
Okay. So, let me throw out this hypothetical for you. Let's say that you have a business owner that is involved with a professional services provider. Oh, I don't know. Let's say a law firm, just for discussion purposes, and knows that there is going to be a large expense in 2024 related to litigation, but has not incurred that expense, but is just thinking about, and upon the request of the alleged service provider, has been requested to dump a bunch of money into trust so that there is that money there to make sure the bills get paid in the next year. Is that deductible, and does it depend if it's cash or accrual basis for the company in as a 23 expense, or is it no? I mean, you have to report it as an asset, meaning a prepaid account, and then a liability that you may have. So how might that work? And you can say it depends. I mean, I just happen to be thinking about that for just a random reason.
So there is a way to accomplish what you're trying to accomplish, but it just requires, going back to why does the government want all our information, probably to prevent me from what I'm about to say, which is, you got to throw an entity there in the middle that effectively acts as sort of your insurance company, whether it's from a conceptual standpoint, so, entities are supposed to be on the same basis of accounting with each other, even if they have technically different base of accounting. So you pay it out from one entity. If the other entity was a C corporation, different fiscal year, you'd at least get a timing difference, between the two from an income pickup standpoint. So you can take the deduction in one entity this year, not have to worry about it from an income pickup, or ideally it'd have the expense incurred in the next year by the time that entity had to file a tax return.
Okay.
That's the way that you would pull it off, so that it, behaves a lot like an insurance policy where you're just shifting to when, like, taking the deduction now, but shifting to when the expense actually occurs, versus having to get the deduction when you actually have to pay it out from not your perspective, Jack, a friend's perspective.
Good to
So,
know.
yeah.
And how about from the payor's perspective, as far as paying, not the recipient of the funds, but the payor's perspective, would they, because they no longer have control of that cash, but it's still their cash, but they haven't really utilized it for its intended purpose, which is paying a legal bill?
Yeah, you'd have to, I mean, either it would have to be income if it never got paid, or alternatively, you'd have to treat it as deferred revenue until you ultimately had to pay it and have the corresponding expense. I mean, eventually you'd have, like, if you never had to pay it, then you'd have to either refund it and it'd be income back to Jack, or sorry, the original payee, or in that entity.
Okay. Good to know if that ever were to happen. Yes.
Yeah, to a friend at
Yes.
a different law firm.
In a different
Yeah.
country. Yeah. Uh-huh.
Yeah, in a different
Canada.
country. Canada.
Canada.
Yeah. It's a lawyer in Canada that I used to date.
Yes.
Yeah, we're not giving advice, but we sure are happy to go through some hypothetical situations for anybody else out there that's listening. You can remain anonymous. You can give us fictional names if you want. But hey, this is kind of your last hurrah for 2023 in getting some live Q&A, questions, answers, and not advice. So
And
hit
in the
us up.
meantime, I'll throw in, and I've said this before, so I know I sound like a broken record. And in fact, in the past week, someone, a mutual client, has reached out to me and said, "Okay, I did what you told me to do, which is look at the operating agreement, and yeah, would like for you to take a look into some things," which is perfectly fine. But really, take a look at your governance documents, and a lot of times things will. The things you're looking for is if you have a buy-sell provision in your operating agreement or your shareholders agreement, and it is insured, or insurance proceeds are part of the process. A lot of times that gets out of whack, the formula, meaning that at the point you got the insurance policies, it covered 80% of what the payout would be based on the value of the company at that time. Assuming the value goes up, you're going to end up being underinsured if you wanted to maintain that 80% coverage of the payout. It'll end up being 75, 70, 60, whatever the number is. So you need to be aware of that. A lot of times, and this happens, which is that, and this is more prospective, that you anticipate filing an S Corp election in the next year, but you need to take that partnership, the operating agreement that was written for partnership taxation, and turn it into and amend it and restate it into an S Corp tax treatment LLC operating agreement. So, I see them, ones that have been drafted years and years ago, and just need a little bit of tweaking in some cases. In some other cases, an overhaul is just more efficient based upon certain things. One thing to look out for is what happens. Put yourself in the place of what happens if you get hit by a bus, kind of thing. And a lot of times, the situation that you were in 10 years ago, which was, yeah, for sure, I don't want, and nor do my partners want to be in business with my beneficiary, who happens to be my spouse. It may be now 10, 15 years later, your perspective has changed, and it is that over the past 15 years, we've built this foundation together. So yes, I do want my spouse to have the benefit of receiving a dividend, a distribution, for doing absolutely nothing for the rest of her life, as long as she owns that ownership interest. So the operating agreement has to be consistent with that, because it may say, no, that your wife, as the holder in the moment, as the beneficiary of that ownership interest, is required to sell it back if the other owners want it back. So just those kind of inconsistencies that just happen because of the passage of time, that you want to make sure that the governance documents state the pathway that you want them to state in that moment. So that would be my 2 cents in reiterating things that we've talked about in the past with respect to year-end planning and planning into the next year.
So I'm going to bring up a conversation with my new friend Ralph, who also works with privately held business owners, coaches them, families, especially. Like, he loves working with families, and he does it all over the world. Really amazing pedigree. But the reason you're talking about, like, in operating agreements, et cetera, well, in closely held businesses, he gave an example where 50-50 partners, brothers, right? It's kind of how it was actually with Joe Foster and Reebok when they bought their father out. That's a fascinating story. If you haven't read Shoemaker, read Shoemaker. But so 50-50 partnership, we've talked about the difficulties of 50-50 partnerships before. But one of the brothers has one daughter who's not involved in the business at all. The other brother has two sons involved in the business, and yet the way that their wills and everything were read, or, that upon the brother that has only the daughter who's not involved, she gets all of his stuff. Well, so she's now a 50-50 partner, and when the other brother goes, it's divided among those two. So the sister, who's not involved in the business at all, doesn't know jack squat about it, now all of a sudden has 50% problem. Like, a lot of times you don't think through that kind of stuff because you did it, got it done. At the end of the year is a good time to think through some of that stuff. Like, yeah, there's a lot going on, but like after Christmas and especially before New Year's, that's a good time for me to just go, okay, what do I need to get clean? What do I need to think about that I haven't thought about because we've been running so hard during the year? So anyway, I just thought that was a very poignant example, and that's not the first time that's happened.
Yeah.
So
Yeah. Go ahead, Jack. You're on mute, buddy.
Sorry, geez, I think I'd know that better by now. All right. So relatedly, and this happened a couple months ago, similarly, passage of time, you have 3 owners that were 1/3 each. So, and then the tie-breaking provision was the fact that the operating agreement required majority consent to most of the important actions of the business. Well, that 33% owner, one of them was redeemed. So you end up with a 50-50, and you have created a deadlock that was unanticipated. There was not language in the operating agreement to deal with that. And there are various ways to deal with that. You bring in an outside party. You have what is called a standoff provision, which is that if you say you think the business is worth 2 million, so your 50% is worth 1 million, maybe you offer the 1 million or 1.1 million, and then the first person who makes the offer, the second person gets to say, thank you. Okay, I'm going to buy you out at 1.1 million. And that has to happen. So it creates a disincentive to make an offer to buy out, and creates an atmosphere of, we need to work this out because our only exit is to, one of us has to be willing to make an offer and accept the same offer. So, and again, there's other mechanisms, but what happened in this scenario is they just, were not getting along. They had no way to break the tie. It did all the bad things that you would anticipate, which it impacted employees because they were fighting amongst themselves. They were not being productive. And so it was on the verge of tanking the business, and not through my efforts, but I help with putting together what the next version of this business looked like and how they would get along and everything else. But so that is, kind of a modified version of your example where you end up with, not needing a provision in an agreement, but because of the evolution of the business and the ownership, you need to infuse something into the relationship in the governance document in order to deal with that bad possibility of getting to an impasse and not being able to get past it.
Yeah, good stuff.
Cool. You okay if I keep the freight train running, Gary?
Keep rocking, baby.
All right, awesome. So the next round of stuff is stuff that you don't need to do before the end of the year, but you do need to consider because it will inform what your April 15th liability looks like, and potentially your January 15th estimated payment. Sorry, I forgot one last before year-end thing. Now that you can get a deduction for your state tax payments, if you pay them through the business, you need to pay your state taxes before the end of the year, just like we used to way back in the old days. So do that. And Jack, you should tell law firms that that's a good idea too to do. Just saying, for a friend. Just saying. Anyway, the stuff to just consider, first off, to the extent that I kind of know what my bonuses are going to be, and I'm going to be paying them out, the first 90 days of the year to people. Just I'm not paying them out with the final payroll. You can take a deduction for those. So, calculate them, accrue them back, take the deduction. That doesn't apply to owners, but it does apply to everybody else, which, most companies that pay bonuses, that can be pretty significant. That's one item. Obviously, we talked about retirement contributions beforehand about getting the W-2 right. Well, those amounts don't actually have to be funded until the tax return is filed. So you want to make sure that you accrue back anything that you were going to fund into retirement as part of just, getting your year-end books closed so that you can get a deduction for it, even if you haven't. That's one of those little gifts from the IRS, regardless of whether you're cash-based or accrual-based taxpayer, you get a deduction for. The next one, and this is like real common, dumb, don't do this, is that you get a credit card bill. So you're a cash-basis taxpayer, so you only pay taxes on money you collect, and bills that you actually pay, and you get a credit card bill, and you put it in your accounts payable to pay the bill. That's not correct. The credit card is actually a debt, and things that are debts are deductible. So you need to pull the credit card out of the accounts payable, separately stated as a debt on your balance sheet, so you can get it. That's so common, and it's so dumb, that happens. The next one is, we've done a lot of discussions around owner fringe benefits. Go hunting, through, hey, did I take a trip? Could the trip double as an annual meeting? Stuff like that. Just go thinking through, what were the things that I've already spent money on that I potentially get a tax deduction for a friend, Jack, for a friend. Unreimbursed partnership expenses, you're welcome. For my friends. So just, be thinking, make it to do to yourself, before I pay my next check to the government, I'm going to go through my bank statements and just think about, of all the stuff that I've heard about owner fringe benefits, including my Taylor Swift tickets, Gary, what could I be taking a tax deduction for? Or at least let me track it and give my CPA a shot at deducting it, versus making my own judgment call, on whether or not something's deductible or not deductible.
So I'm going to interject real quick before you move to the next one, because Robert Mayetta, good to see you here, Robert. Does the estimated state income tax payment deduction apply to an LLC or only S corps?
It's both. It's all flow through entities in North Carolina.
Good to know.
And I'm going to throw in a little tip too, which I do. I used to use Quicken, and then, and have a category of unreimbursed business expenses. But now that credit card companies will allow you to do sorting and searching and then downloading into an Excel spreadsheet, it makes it easy to be able to say, okay, here are my thoughts on this or that, whether it's dry cleaning, cell phone expense, home office expense kind of thing. So, that is something that is not maybe readily apparent when you go onto especially people that are using their phones for now credit cards. But if you go into the full interface, there's more functionality on the Chase Bank website to be able to do things like that.
Yeah, that's right. That's I mean, we're coming up on time, and that's the big stuff. If I think about, what do people always mess up, those are the items that people always mess up.
The accounts payable one is a good one. I was thinking, I said dope in my head because I'm sure our finance people know that, but I'm just thinking, how easy is that to do? To just
Oh yeah.
because it's like, yeah, it's just like another bill, so put it in there and don't consider it a traditional debt.
Especially the corporate Amex, because you're paying that off every month anyway. That is so common. But if you think about it, it's like if you're using the Amex for everything that's not payroll related, so you can get the points on it. It's like you've got clients that, $300,000-400,000 in expenses each month that they're missed. Like they get the deduction. It's just they're safe. It's next year, not, the year that they
Yeah.
potentially get it. And I guess last thing, on the, hey, you don't need to do this before year end, but it's one of those things to consider as you're thinking about what am I going to owe is, part of the 2017 Tax Cuts and Jobs Act is that they raised the threshold for a lot of cool stuff for businesses that are below $25 million on a trailing 3-year basis in sales to be able to be on a cash basis or a modified basis where you otherwise would have had to be accrual. So what does that mean? Like if you're in construction, raise the bar on the ability to do completed contract. If you manufacture stuff, it raised the bar in the ability to deduct some of your inventory expenses in the cost of goods sold, even if it was still inventory. So just, stuff to ponder.
And that cash to accrual threshold at 25 million, isn't it like 3 years of average or something like that? Or
Yeah,
like
it's a trailing 3-year average. So I mean, even if you just popped it this year, you're technically not in it.
Okay, cool.
I have one more question before we
Sure.
go, and this is more of a personal preference. You're probably going to say, well, it's a personal preference, but as far as, let's say that you don't have a company issued credit card, you have personal credit cards, would you recommend having a separate credit card for business only expenses and keep that separate, or is it really just preference as to how you organize your finances?
I would keep a separate credit card just for the business for two purposes. One is it keeps your record keeping, it just makes your life a lot easier. And related on the life being easier, if you ever were to get audited, it's a lot better position for me to be in to say, I only use this for business and I've got a great, track record to show that's very clearly business, versus, I intermingle stuff, but wait, Jack, IRS agent, this Costco receipt really was for the business, whereas this Costco receipt was not. It makes your life a lot easier. In both cases.
Thank you. That's what I do. So it makes me
Good
feel
job.
better.
Good job.
Good stuff, guys. And another great crew joining us. So, and it's coming upon us, man. We got 13 more episodes before we have our 200th week anniversary. So we got to get planning, man. We got to
Big
do
bash
something.
time.
That's right.
Big.
That's right.
What a fun ride this has been. It's been a wild ride too, but it's been a fun ride with you, Jack and Adam. So thank you everybody for joining us. We'll continue to do this as long as we provide value and as long as people show up. So Merry Christmas to all of you guys. Thank you for your impact in our community and trying to do the right thing and, trying to run your business as good as possible. So thank you. We really appreciate all of you. All right, Jack, I love the hat. Put it back on the tree.
Yes.
That's right.
Yeah, I'm not allowed to leave the house with it because it might not make it back. So yes. And happy holidays, Merry Christmas to everyone. And I guess Happy New Year if we're not going to do the next one until January. So
That's right. I'll see
Yeah.
you next year.
all right.
Wasn't that the most fun thing to say in elementary school?
Yeah. Yep.
That was so much fun. All right. See you guys. Take
All
care.
right.
Bye.
See-
Thank you.
Bye.